Don't buy stocks. Do this instead. Today I want to explore a contrarian perspective on investing, one that challenges the status quo. Don't buy stocks. Do this instead. This advice is not mine. It comes from Warren Buffett, the renowned investor and philanthropist. His early investment methodology didn't prioritize buying stocks based on market trends. Warren Buffett's early investment approach actually was investing in stocks based on market prices, an approach that had a different guiding principle that would eventually form the cornerstone of his enormous success. Investing in stocks based on market prices is something very different to intrinsic and value investing. So let's first examine the conventional approach to stock investing. A typical investor buys at a low market price with the expectation of selling at a higher market price. This practice, while straightforward, can be vulnerable to market fluctuations, making it potentially risky. But the investor spends his whole time just looking at the market and seeing where the prices are moving and hoping that the low price that he'd bought the stock at will actually become a high price in due course. So essentially, he's watching stock prices and he's trying to guess the direction of the market and hope that he can sell out higher than he bought at lower. So the stock and the stock price is all he's really focusing on. Now, under the influence of Benjamin Graham, who's widely recognized as the pioneer of value investing, Graham's teachings usher us into the crux of the discourse today, which is value investing. As Buffett's mentor and in fact tutor and in fact employer, Graham's teachings set out in his classic work, The Intelligent Investor, significantly shaped Buffett's investment philosophy. Adopting the investing in businesses philosophy is what it's all about. This shifted the perspective to evaluate intrinsic value and the quality of businesses from simply looking at the stock price. And this means that instead of watching the stock prices go up and down, you fundamentally focus on the underlying business and its value rather than the share price and what that number is telling you, which is very little. Value investing is a strategy premised on discerning and capitalizing on undervalued stocks, but to do that you have to understand the underlying value of the business. So the undervalued stocks are where the market price doesn't reflect the intrinsic value of the business, but you have to do your homework on the business to work out its intrinsic value. The stock price doesn't tell you anything. So take, for example, the case of Apple in the late 1990s. Despite struggling financially, their core business model and product potential, the intrinsic value, was very strong. Value investors recognized this and reaped immense rewards when the company recovered. Buffett evolved Graham's philosophy by not just considering stocks, but fundamentally focusing on businesses. Here, the focus shifts to the understanding the business model, the profit potential, and overall quality of the business behind the stock and the share price in the market. Another example is Buffett's investment in the Coca-Cola Company in 1988. Despite being a publicly traded stock, Buffett didn't just see a stock. He saw a strong business with a solid market share and an amazing global brand that had been loved for generations. The result of his approach has been extraordinary. Buffett's investment strategy has consistently delivered market outperformance, producing substantial wealth and securing his position as a foremost, if not the foremost, global investor. So the importance is fundamentally about understanding the business behind a stock. And you have to understand the underlying business and not just worry about the stock price. So in Buffett's words, never invest in a business you cannot understand. This brings us back to our central theme. One must not simply purchase stocks, but comprehend the businesses that they represent. So when contemplating an investment, remember this lesson from Warren Buffett. Conduct thorough research, gain an understanding of the business, and base your investment decisions on intrinsic value rather than just the market price, whatever it happens to be doing today, yesterday, or tomorrow. This isn't merely a process of buying stocks. It's a method of acquiring businesses. So my premise is simple. Don't buy stocks. Buy businesses. Stocks are a part ownership of a business, albeit probably a very small one. Taking this approach is much more likely to lead to investment success than trying to guess the share price tomorrow. So I hope you get it. Don't buy stocks, buy businesses. Don't worry about what the stock price is doing this week, next week, or whatever. You should be buying a long-term share in a very high-quality business with a view to holding it for 2, 5, or 10 years and reaping the rewards over time of the compound growth of that fantastic business. What the stock price is doing doesn't matter.